Hey everybody. So I thought I'd do my first ever live stream Q&A. I do a lot of YouTube videos and on my videos I get a lot of questions and I always feel kind of guilty that I can't answer everybody's questions. But I mean, I literally have thousands of comments and it's just hard for me to answer everybody's questions. So I thought I'd do a live stream and kind of answer a few of the most interesting questions that I've seen on a few of my videos. And if anybody watching this wants to ask some questions as well, I'd be more than happy to answer your questions here live. So let's go ahead and take a look at a few of these questions. I'm going to go ahead, if I share my screen. And so when Cohen asks, 15-year or 30-year mortgage, what would be ideal? And that's a great question. And so I recently purchased a home, and somebody like Dave Ramsey is constantly preaching everybody should get a 15-year mortgage, and you should always put 20% down whenever you get a mortgage. And I'm actually not a big fan of that. I am actually a much bigger fan of going with a 30-year mortgage. And that's personally what I chose. So the reason for that is there's a couple arguments for that. So one is there are arguments for both 15 and 30 year, but the argument for a 30-year loan is going to be opportunity cost. So I recently just bought a $400,000 home. I got a 2.75% interest rate. I could have put $100,000 down on that home, and sure, that would have lowered my monthly mortgage payment, but I chose not to. Instead, I wanted to finance as much as I could because of that low interest rate. And I believe that I can get a better return on my money than 2.75%. That's super, super low. You can just pretty much invest in like any index fund and you can be able to get that. There used to be banks that give you higher interest on your savings account. Not anymore since the Federal Reserve lowered their federal funding rate. There used to be banks that you could get a higher return on your money than that. I could take that money and invest it in real estate, buy an investment property or something, get a much better return on that. The S&P 500 over the last 100 years saw an average return of about 10%. So you could get 10% return on your money. So opportunity cost is one reason why I wanted to go with a 30-year loan and put as little down as I can. The other one is that there's actually a pretty good argument that you can take advantage of inflation by borrowing as much money as you can on long of a timeline as you can. This is one way that we can actually benefit from inflation. And it's kind of hard to wrap your head around it. And it's kind of hard for me to explain it as well. But this is something a lot of big businesses do. They'll take out a $50 million loan and pay it back over 50 years or 100 years, something ridiculous like that. And the reason why is because at the end of that, your $50 million is going to be worth a heck of a lot less than it was at the start of that because of inflation, because your money is actually losing value every single day. Okay, I just bought a $400,000 home on a 30-year mortgage. My mortgage payment is $2,000 a month. And right now, that's pretty significant. But in 30 years from now, that mortgage payment is still going to be about $2,000 a month. But money itself has lost value, but I've been able to lock in that low rate. So as money loses value, my expenses stay fixed. And that's one of the ways that you actually benefit from inflation when you take out a large amount of debt on a long enough timeline. So that's personally why I chose a 30-year loan. It's just I'm in no real rush to pay off my primary residence. I'd love to pay it off at some point, but right now I'm young. I want to get a little bit more aggressive with my money and in my investing, and I have no problem going with a 30-year mortgage. And for the average person, you shouldn't really. I tell people don't really focus too much on the sales price. Focus more on what your monthly expenses are, what your monthly costs are, and with a 30-year loan, I mean, you can simply afford a larger home for a lower monthly fixed rate, or you can afford the same home as a 15-year loan, but again, your monthly mortgage payment is going to be higher, I guess. No, it would be lower. Yeah, it'd be a lot lower. So that you could afford a $400,000 home, but your mortgage payment would be significantly lower with a 30-year rate, which would allow you to invest in other opportunities where you can get a better return on your money. So that's kind of my personal opinion. And really 15-year loans are not all that common. The only real benefit to 15-year loan is that your interest rate is typically lower. Um, Typically, it's anywhere between like 0.25 to 0.5% lower, so half a point to a quarter percent lower. Interestingly enough, a few months ago, we actually saw that flip where the 30-year was lower than the 15-year. But that's really the only big advantage of that. So if your goal was to get out of debt, that may help you. But what you could also do is do a fifth 30-year loan, then simply make extra payments to your mortgage every single month. You don't get advantage of having a lower interest rate, but you can still pay down your principal much quicker than 30 years. So, Carmen asks, you mentioned if we put this extra money down early in the loan, it'll decrease the amount greatly. But what if you have 10 years left on the mortgage? Does this still greatly benefit me or not really? What about home equity line of credits, HELOCs? Do these suggestions also work well? So, this is on a video I did 10 hacks to pay your mortgage off early. And yeah, so it's pretty interesting when you start playing around these early mortgage calculators. And make if you start making extra payments towards your mortgage early on, it can save you years and years off the ending of your mortgage. You can pay that thing off so much quicker with just any kind of extra payments. Whether it's $50 or so a month, you can really have a pretty significant impact on your mortgage payment. So he says he only has 10 years left. Should he still make extra payments? If your goal is to pay off your mortgage, then yeah, I'm all for that. How the interest is applied. So let's say you have a 3% interest rate. They take what your remaining balance is. So let's say you have $100,000 left. They multiply that by 3%, and then they divide that by 12 for 12 months in a year, and then that's the number that they apply towards your monthly mortgage payment, is whatever that number is. So if you only have 10 years, it's still really beneficial to make extra payments towards that mortgage so that you're not paying as much interest over the next 10 years. So if that's your goal, get out of debt as soon as possible, then yeah, man, I'm all for that. So let's take a look again. Where did that one go? Here we go. So John asks, I'm really interested in using my VA loan for a quadplex in Texas. Not sure if it is better to buy an existing property or have it built. Yeah, so a lot of people don't know this, but with a VA loan and FHA loans as well, you can buy up to a 4-unit. They still consider that a single family residence. Anything above 4-unit is when they consider that a commercial residence. So I often tell, my service members, feel free to buy a 2-unit home or 3-unit home or 4-unit home. Unfortunately, in Maryland, they're just not that common. But I think out in Texas, you can buy more things like that. So he's asking if you should buy one or have one built. I mean, that's kind of a good question. You really have to crunch the numbers on what your expected monthly income will be from that. My concern is if you bought one, they probably are already looking at the investment potential of it and working that into the price. So it's probably going to be pretty expensive to buy a 4-plex or a 3-plex or 2-plex, whatever, already, because they know that they're selling it to an investor. But yeah, I mean, I think if you built one, I don't know too many builders right now who build one from scratch. Like there's a lot of these new construction communities and everything, but there's not many. You may have a hard time finding a builder who would build one from scratch. And you may have to find a zoning that's zoned for multi-unit as well. So buying one would kind of save you that headache. If it's your first investment property like that, you may just want to buy one just to kind of save a few of those headaches. But a lot of people don't know that you can buy a 4-unit using the VA loan. So let's take a look here. Yeah, so if you guys have any other questions, feel free to comment down below with those. I'd be happy to answer them. So good morning. We just bought a home in Texas and our current interest rate is 3.75%. Being that we were in the first month of ownership, would it make sense to refinance now if possible if the interest rates have dropped down to 3%? We already plan to make extra payments, but we're trying to learn the best way to keep as much much of the money in our pockets as we can. Also, allow me to take care of my mom. So yeah, that stinks that you got 3.75% and a month later they're down to 3%. I personally, I mean, I'd be very hesitant to refinance right now. So a lot of people don't tell you, or you don't think about, is that there's a lot of closing costs in order to refinance. When you refinance to a lower interest rate, they may charge you five, six, seven, $10,000 in order to do that. And oftentimes what they do is they just add it to your loan so you don't even know about it. And they may charge you that $10,000 in closing costs, but because you're still getting lower interest rate, your monthly mortgage payment may still be lower than what it was previously. Um, so it's something just to really watch out for. I mean, you already paid a lot in closing costs to buy the house, and now you're going to pay another $10,000 to get in a lower interest rate. What you really need to do whenever you're doing a refinance, you need to look at what the savings is going to be, projected savings after closing costs and everything. And let's say you lowered your interest rate, you can now save $50 a month. Well, great. How long? $50 a month in interest, right? That's the only thing that's changing is interest. How long do you need to live in that house before you will recoup that savings? So if it costs you $7,000 to refinance to save $50 a month, how many months until you saved more than that $7,000? And in most cases, it's probably going to be like 6, 7, 8 years that you need to live in that home before you recoup that money, depending on how much of a price interest decrease it is. Yeah, actually, if you went from 3.75% to 3%, it may be shorter than that. Maybe like 4 years or so that you'd have to live in that home, depending on like the price range and everything. How much your closing costs are. And if you are intending to live in that home for that long, by all means, you can do that. But I'm pretty another thing that you need to look at though. Now, you just bought the home, so you're at the very start of your amortization schedule. But what gets me is a lot of people, they'll get 10, 15 years into their amortization schedule, and then they will refinance, and now it kind of restarts the amortization schedule. And what that means is how much of your monthly mortgage payment is going towards principal and how much is going towards your interest. And a big reason why banks will advertise that will lower your monthly mortgage payment because less of your payment is going towards your principal when you refinance like that. So let's say you're like 15 years into a 30-year mortgage. You may have like $600 a month going straight towards the principal of your loan. So that's almost like a savings account that you can't touch until you sell your house. So it's kind of like forcing you to save your money. But if you refinance, you're now not putting as much towards the principal. That's really where the savings is. And it makes you feel like you're saving money, but really you're building equity much, much slower. So I'm typically pretty hesitant about recommending to people that they jump at refinancing their home. Just kind of know that you have high closing costs and you're not going to be building equity in your home nearly as quickly. Now, it can still make sense sometimes, especially with how low interest rates are right now, or especially if you want to do a cash out refinance and take that money to invest in real estate or do some other kind of big investment like that. It can make sense in some of those situations. But for the most part, I mean, I just be hesitant about those flyers that you get in the mail saying, hey, we can reduce your mortgage rate. But so I had a client that called me up the other day and like they have a $1,900 a month mortgage payment, and they got some flyer in the mail saying they can get their mortgage down to $1,200 a month, and it's nonsense. That's false advertising. And what they're doing is that they're only factoring in the principal and interest on that $1,200 a month. That's why it's such a big difference. They're not factoring in the property taxes, which is part of your monthly mortgage payment, and they're not factoring in the insurance, your property insurance, which here in Maryland it's maybe $100 a month of your mortgage payment goes straight towards your insurance. And they're also not being super transparent about what their closing costs are and how much is going to cost those people to refinance their home. Because in this particular case, they're thinking about selling in 12 months and they wanted to refinance now and then sell in 12 months. And I was like, no, 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 no. It's going to cost you like $7,000 in order to refinance that. Like that is nowhere near long enough for you to recoup the cost of refinancing your home. So I'm always very weary about that, and I just you really want to take your time and do some research if you're refinancing a home. I will say that my personal prediction is that interest rates are going to continue to drop. I still think that they're going to go lower than they are right now. So interest rates right now, they're heavily influenced by the federal funding rate, how much the Federal Reserve lends money to the banks. And if you guys remember, when the Federal Reserve dropped their rates to near zero, it was like they dropped it to like 0 to 0.25%, right? And what happened was the banks quickly dropped their interest rates from like 4 almost down to 3 for like a day or two. They got so overwhelmed with people trying to refinance and people trying to buy homes and lock in that low interest rate. They had to raise their bank's rates again just so that they had fewer clients and fewer customers because that was the bottleneck. They couldn't handle that many people trying to refinance all at one time. And so now, so it went from like 4 down to 3, then 3.5, and now it's slowly been coming down at a more reasonable rate for the last few months. And right now it's sitting around 3%. So we're seeing some people below 3%. I think it's going to keep going down lower and lower over the next like 12 months or so until we at some point get to like whatever the minimum is that a bank is willing to lend money at, because they're getting that money for 0% interest and then lending it out for 3%. So they're making 3% profit. I think it's going to keep going down. It won't go down to zero because the bank has to make some sort of profit, but it may go down. It may go down to 2%. I honestly wouldn't be surprised if interest rates went down that far. And I do have one rental property that I'm kind of keeping an eye on it, trying to figure out when do I refinance that and lock in a 2% interest rate because I've got a 4% interest rate on it right now. So that'd be pretty significant. But the Federal Reserve has already come out and said that they intend to keep their federal funding rate at near zero for the next 3 to 4 years. So interest rates they're going to keep coming down. That's my personal prediction. So let's take a look here. I think I had another comment. So that's Derek's comment. Mark, all great and sensible tips. I do several of these and love the idea of being debt free. But what about the opportunity cost? Yeah, I talked about this earlier. Wouldn't it be better to invest all the extra money in stocks and then pay off the mortgage all at once when your investment grows to the value of the mortgage? Theoretically, this would happen a lot faster. Yeah, so this is a really good argument, and some people who are a little bit more risk tolerant may want to try this strategy. So, if you look at the return of investing in an S&P 500 index fund over the last 100 years, your average return is like 10%. So the argument is here, you could put your money into investing, um, and then earn 10% on that money every year instead of simply avoiding 3%, right? That's a difference of 7% interest rate there. And yeah, I kind of agree with that your money would quickly accumulate to being more than the value of your home much quicker. And then you could quickly pay off your home all in one lump sum. And you absolutely could do that. I'm not opposed to that strategy at all. I think that's not a bad strategy right now with how low interest rates are. Now you have to also factor in that if you're investing in like the stock market or something, it's not as safe as simply paying off your mortgage. That's like a guarantee right there. Stock, who the hell knows what's going to happen with the stock market? I've kind of stopped trying to predict that right now. Um, yeah, who knows? It could be crashing. It could see all-time high again and again and again. It's really hard to say. So there's a little bit of a risk there, and then you also have to look at, what's your capital gains tax going to be on any of that. So you invested in the stock market. When you pull it out, if you have to pay 20, 25% or so of that to capital gains tax, that means that you have to actually save up a heck of a lot more than your actual mortgage costs may be. So you have to kind of crunch the numbers there and see. But if you're a little bit more risk tolerant, that may be a good strategy for you. Or there's other investment opportunities if you wanted to flip a house or start a business or something. Again, it's all about risk. Paying off your mortgage early is kind of a safe, guaranteed savings account right there. All right, and that brings us back to this very first one. I get all these. Yep, I think I got all these. So these are all comments from my YouTube channel. If you guys ever have any comments on there, I'll try to address it. But yeah, I think that's it for today, guys. Thanks so much for joining. If you are not subscribed to my channel yet, go ahead and do that. Malcolm Lawson Realtor. And I hope to do some more Q&As like this in the future. I'll get, just a collection of comments from my different videos and just try to get on here and try to answer them from everybody. Okay, signing off. I'll see y'all later.